Morning, everyone. Thank you for joining us today for our webinar on tax considerations for expats living in the UK. Thank you for all having taken the time out of your day to join us, and hopefully we can help you with a few things that you might have not considered before, or different areas that, as I said, haven't crossed your mind before. So first of all, just to get us started, we just need to quickly go through the disclaimer. I'll just leave it on screen for a couple of seconds, just so we can go through it. But basically, it's just to say that our advice is in this webinar is generic. It's not complete advice. If there's anything further that you need advice on or specifics for your specific situation, please consult with us or anyone else on any of those specific areas to get a formal disclosure done. So who are we as Sail International? We were founded in 2002, and we're a team of professional tax and commercial advisors with a global footprint in helping you optimize your tax position and remain compliant across multiple jurisdictions. Now, you might wonder, what does that mean? It's a bunch of fancy words, but what does it actually mean? Essentially, we are a one-stop shop where you can come to us for multiple tax matters from multiple countries, whether you have operations overseas in Spain or South Africa or America. You can come to us and we'll be able to help you either through one of our trusted partners, or internally as our team, we'll be able to give you advice on your different tax countries and what is best and how best to go about it. Now, in this, today we'll be covering the following topics: UK tax considerations, cross-border tax considerations, corporate structuring, how we can help with all of these. We'll be doing a Q&A at the end. The presentation is meant to be roughly about an hour long, and then there'll be Q&A afterwards, where if you are able to stay, please stay and join for the Q&A, and then we'll share our contact details as well as a link to set up bookings with us if you do wish to do so. I'm just going to quickly run two polls to go through a couple of things, and if you can just give us some feedback on those, and then we'll get started into the main part of the webinar. First poll should be coming up now. It's just a thing to ask: where is your home country, and where have you come from to the UK, or where have you left the UK to go to, just so we can get a gauge on the countries. This is not a full list, but it's just a idea for us. To clarify, yes, there will be a recording done of this webinar, which will be sent out to the attendees afterwards, so that if you do have any questions or anything further that you want to refer to, we will send it out. Perfect. Thanks for your responses, everyone. And then just the second poll, just to discuss, or just to ask what your reason for attending today is. Thank you all for your answers. So it's a very, very wide group of people here today from various countries: Spain, South Africa, Australia, USA, and a couple of others. So hopefully we can address any questions you have later in the Q&A. And then the same with your reasons for attending today. Some are looking for UK tax residency experience, and all of the other options are also being chosen. So we'll hopefully discuss everything that applies to you guys. But perfect. So first of all, we will look at the UK tax considerations. Now, the UK tax is quite interesting, the way it works and what tax residency means in the UK. In some cases, you can be UK tax resident by spending as little as 16 days in the UK in a tax year. Other cases, you can spend up to 182 days in the UK before you're seen as a tax resident. These are all discussed under what's called the UK statutory residence tests, and they're broken down into three parts, being the automatic overseas tests, the automatic UK test, and then the sufficient ties test. So there's an old story that goes about a person that had three personal assistants, one to discuss and cover all of their business meetings, one person to do all of their personal parties and events that they were attending, and a third person just to look at different countries and how many days they could spend in each country before they were seen as a tax resident in this country. Now, you might think that's excessive, but when it comes to tax residency, it can be very important because you might not realize it, that just by stepping into some countries, you automatically become tax resident, while other countries, you have a much wider or much longer time frame before you're seen as tax resident. So if you're traveling anywhere and you are going to be doing some business there or any other activities there other than mainly just a holiday, it's always important just to consider tax residency from any country. And the UK is no different from that. So most people in the UK, you automatically become tax resident if you spent 183 days in the UK. And then that can be, as I said, down to as little as 16 days, depending on your specific circumstances. So if you've just moved to the UK or if you've left the UK in the middle of a tax year, the UK tax year running from 6 April every year to 5 April the following year, there are also then some exemptions or different options that you can apply. One of them being split year treatment. Now, this is a very useful thing to apply, and it applies in the year that a person's either left the UK or moved to the UK. So UK tax residency, if you're a UK tax resident in any tax year, your income for that whole year, your worldwide income, is taxable in the UK, no matter whether it's earned overseas and you don't bring it back to the UK. I'll discuss that slightly later in the non-domicile changes. But if you're just a UK domicile individual, your worldwide income is taxable in the UK. So if you're seen as a tax resident for that year, all of your income is taxable. Now, that's quite cumbersome, and also, you might have come from a country that might have not had a high tax rate, so you might have paid very little tax on your salary for, April to December. Now you've moved to the UK in January, and if you're seen as a UK tax resident under one of the statutory residence tests, all that income you moved before moving to the UK would be taxable in the UK. So then it's essential to look at the split year treatment options so that all that foreign income that you earned before moving to the UK would be exempt from tax. There are different ways that this applies. One of them is having a home in the UK. One is if you're moving with a spouse or partner. Another one is starting full-time work in the UK. And then there's a bunch of tests as well with the same dynamics. But if you're leaving the UK and have a full-time overseas job or no longer have a home available in the UK and only a foreign home, all of these are then piled together as what's called split year treatment. And then we'll be able to assess whether these apply and how these can be used in your case to reduce your UK tax burden. Another one of those that's available to non-residents, either in the year that you've ceased tax residency and applied split year treatment, or in any year that you're non-UK tax resident, is what's called the Section 27 exemption. Now, it doesn't really have a everyday term, but essentially what it means is that if you're working for a UK employer, you can get that income exempt from tax in the UK by claiming Section 27, and therefore it is only taxed in the country in which you're tax resident in. Now, there's certain criteria that has to be followed in order to apply this, but essentially, if you are all the time outside of the UK and you don't spend any time in the UK, all that income should then therefore be exempt in the UK, and only the days you spend in the UK while working would be taxed in the UK. So it's a very useful way of reducing your tax in the UK. So just a quick case study on that to explain it in depth, as well as bringing in split year treatment on it. We had a client leave the UK in August 2023, remained employed by a UK employer. They were earning roughly £118,000 a year. They had UK rental income of just over £7,000, and they made pension contributions per year of £24,000. So before they came to us to do a split year treatment, they were going to be taxed for the entire tax year as a UK tax resident and be liable to almost £38,000 in tax. Now, after we did the assessment, we realized that they could apply split year treatment because they were no longer had a home in the UK and were outside the UK permanently, and therefore we could also apply the Section 27 exemption for the workdays spent outside the UK. And once those were done in their self-assessment, they were then only liable for just over £8,000 in tax. So this represented a tax saving of almost £30,000, which for a tax year is very nice. And especially if the other country you're living in is a low tax jurisdiction, you won't have to pay tax in that country either. Now, there are also things to consider there because they had UK rental income. They had a personal allowance which would have covered some of that. But if they move to a country that doesn't have a double tax agreement with the UK, or for some reason they aren't able to claim a personal allowance, they would then lose their personal allowance in that case and not be able to claim it, because some non-residents cannot claim a personal allowance. So, like I said, every case is different, so you just have to consider it for your specific case. Now, to go into what the big topic at the moment is the change and the end of the non-domicile tax system. So from 6 April 2025, the UK is changing from a domicile-based tax system to a residency-based tax system. So essentially what that means is, as I mentioned earlier, if you're UK domicile, nothing changes for you. All of your income from the UK and abroad is still fully taxable in the UK. But if you were a person who was a non-domiciled in the UK, meaning that you see your permanent home as being outside the UK, or you're born outside the UK, your parents were born outside the UK, you have claim to another home or another domicile, therefore you can claim non-domicile status. That also needs to be assessed case by case in more detail. But essentially, if you could claim non-domicile, you could use what's called remittance basis, where any foreign income you earned in the tax year was only taxed in the UK if you brought it into the UK. So therefore, it's essentially exempt in that tax year if not brought into the UK, and then it's only taxed in the year it's brought into the UK. So it was a good way for non-domicile individuals to keep their foreign income from being taxed in the UK if they were never going to remit it, or if they do in the future, it would only be taxed at a later stage. Now, with that being said, with the end of it, the government has basically given two new conditions that apply, transitional rules being the temporary repatriation facility, and then a new rule being the foreign income and gains regime. Now, the temporary repatriation facility applies to these individuals who were non-domiciled in the UK. So any income that they claimed remittance based on and have not brought it into the UK would then be live up to 6 April 2025. You'd be able to claim temporary repatriation facility, or the TRF. And what this means is that instead of it being taxed at your normal marginal tax rates of 20, 40, or 45% for income, or 8.75, 33% for dividends, you're now taxed at a flat rate, no matter what the type of income is, at a flat rate of 12%. So it can be quite a big tax saving on that. If you're now wanting to bring that money in, but you never brought it in because it was always going to be taxed at such a high rate, you now have the option to bring all of that income in within 3 years after 6 April 2025 at a rate of 12% for either the 25-26 tax year or 26-27 tax year, and then that rate goes up to 15% for the 27-28 tax year. That income does not necessarily have to be brought into the UK. It only has to be designated in one of those 3 tax years mentioned, meaning you can leave it overseas, but by designating it, you then get that reduced tax rate of 12%. And if you bring it in 10 years' time, then you've paid your tax at 12% and you can bring that money in at that point tax-free. Then only future gains or income on those funds would be taxed. So it's a very nice way of getting that money in at a lower rate. Then the new one is the foreign income and gains regime, or the FIG regime. Now, this applies to new residents who have either moved to the UK after 6 April 2025, or people who have moved to the UK before 6 April 2025 but have spent less than 4 years in the UK. What I mean by less than 4 years, that would be 4 years of tax residency. So if you've applied split year treatment or DTA residency, those don't apply. It simply would be under the statutory residence tests. We would then look at those. If you're a statutory resident for 3 years before 6 April 2025, it would mean you would have 1 year of claiming the FIG regime after 6 April 25, therefore the 25-26 tax year. This FIG regime is a very good benefit granted by the government. Essentially, all of your foreign income in those years that you can apply FIG will be fully tax exempt, meaning you pay no tax in the UK. Once again, if you consider foreign tax, you might still have to pay foreign tax, but on certain income, as I'll discuss in the next case study, there was exemptions overseas. So essentially they managed to get all of their income out of the foreign country and into the UK at a very low, or actually at no tax. So it's a great way of looking at it, and then it can be applied based on your residency and your first 4 years. So as I mentioned in that case study, we had a client who wanted to withdraw their foreign investments. These were situated in South Africa and Isle of Man, and they wanted to bring them into the UK as tax efficiently as possible. Now, the funds that they had overseas were shares, endowments, pensions, and retirement annuities, equal to roughly £1.1 million. Now, they had moved to the UK in December 2020, and they were UK tax residents from the 2020-2021 tax year, and they were non-domicile originally. So still claiming non-dom benefits. Now, in the assessment, we advised them to dispose of all their foreign assets before 6 April 2025 in order to be able to claim remittance basis. Then, as they've claimed the remittance basis, they will not bring those funds into the UK before 6 April 2025, and then they would designate those funds in either the 25-26 or 26-27 tax years to utilize the 12% TRF rate. Now, this, in all, equated to almost £200,000 in tax savings. Now, if, for example, if you think about it, if they were able to apply the FIG regime and pay no tax, they would have been able to save even more. But at 12%, it just shows how much they saved compared to having had that income tax in the UK at 45%, because they were in the maximum tax bracket. So it was a 33% tax saving. So yeah, it's a very useful measure and can be used quite cleverly to bring funds into the UK if you wish to do so. Sorry, just grab up some water. Now we'll look at the cross-border, excuse me. We'll look at the cross-border tax matters and how these can apply in different scenarios. The first one being double tax agreements. So as I mentioned, DTA tax residency earlier, some double tax or all double tax agreements have what's called tax agreement residency. And essentially, if you're tax resident in both countries, you will then have to go to the DTA to determine which country you are seen as solely tax resident in, or which country would have first taxing rights. Now, a lot of different double tax agreements have different measures. So these are brought into account in different ways. So it's always important to compare that tax agreement to different countries. So for example, in the previous case study, I mentioned that their income wasn't taxable in South Africa, or a large majority wasn't taxable in South Africa. And that I was specifically referring to the pensions and retirement annuities. The double tax agreement between South Africa and the UK has a clause stating that the income is only taxable from pensions and annuities in the country which you are tax resident in. In this case, the client had ceased their South African tax residency. They were solely UK tax resident. So now, even though they had worked in UK for a large portion, in South Africa for a large portion of their life, those funds could be completely withdrawn from that retirement annuity in South Africa, tax-free in South Africa, and then brought into the UK at 12% under the TRF rate. There are obviously certain requirements and things that need to be done in order to withdraw those funds in South Africa, which those from South Africa will know can be quite a mission dealing with SARS. But essentially, if you follow the correct process, you won't pay any tax on the withdrawals in South Africa. And if you've ceased tax residency more than 3 years ago, you can take out the full lump sum, not just the 1/3 as you usually can, and then bring it into the UK at whichever effective rate applies to you. With the double tax agreements, like I said, it's always important to look at it, because in that case, South Africa didn't have taxing rights. So we had another client where they didn't follow the proper process, withdrew their pensions, and then HMRC wanted to tax them, or HMRC rightfully taxed them. They wanted to claim the tax credits paid in South Africa against that income, and HMRC declined those tax credits, saying that South Africa, in fact, doesn't have taxing rights under the double tax agreement, so we're not allowing the tax credit. You then have to go back to SARS, South African Revenue Services, and claim that tax back from them, which can be quite a long process. So do the process correctly the first time, and then that saves you trouble down the line. With that said, if there is no double tax agreement between countries, you still get what's called unilateral relief, which essentially means your foreign taxes in those that you paid in another country should be allowed as a tax credit in the UK or vice versa, whichever way the income is flowing. And like I said, that the DTA gave no taxing rights to South Africa in that case, but a unilateral leave, that won't apply. So then you should be able to claim the credits in the other country. And then with those, a lot of the times, also with cross-border tax matters, you must always consider ordering of taxing rights. Now, the UK will have taxing rights to assets situated within the UK first. So wherever you are, if your assets are normally situated in that country, they'll have taxing rights first. And then the second country that you might be tax resident in will have secondary taxing rights. Once again, compare that to the double tax agreement to see whether one of the countries or both the countries have taxing rights. Moving on to the case study on that, we had a client who moved back to South Africa from the UK. They continued to trade through their UK business, earning roughly £130,000 in profit a year. And they wanted to find the most tax efficient manner to get profits out of the UK company while still operating as a UK company. So he went through all the requirements, and they weren't, as I'll discuss corporate structuring later, but they weren't seen as a controlled foreign company under South African tax law. So they could operate as a UK company while still being based in South Africa. So in the UK, they were going to have to pay, we suggested that they pay the maximum corporate tax rate in the UK, which in their case would have been 25%, being £32,000. Then they can declare the remaining profits after tax as dividends, being the £97,500. And then in the UK, you can do what's called disregarding investment income, which essentially means if you're earning income in the UK, investment income, dividends, interest, that type of income, and you're not resident in the UK, you can disregard it in the UK and then have it only taxed in the country which you are resident in. So we suggested disregard the income in the UK. And then in South Africa, there's what's called a dividends participation exemption for shareholders that own more than 10% of shares in foreign companies. Any dividends they receive from those companies is exempt from tax in South Africa, or dividends tax in South Africa. So essentially, they would be able to get all the profits out of the company without paying any further tax in the UK or South Africa. Now, in this case, their overall effective tax rate dropped to 14.3%. And as you'll see there, I've said the tax saving is dependent on their desired outcome. In this case, it was very simple. They just wanted straight salary. They weren't worried, straight dividends. They weren't worried about salaries or contributing to national insurance so that it counted as a qualifying year for state pension purposes. But once again, we would assess that, come up with a structure for you that would then be able to customize for your specific needs, whether you want, as a qualifying year for state pension, or if you're still wanting to take a salary out to be able to use your personal allowance, if you're able to still have a personal allowance, and then claim any exemptions from there. And also while doing that, this was all for South Africa based, so we included the South African double tax agreement. But if you are somewhere else, we would then consider the UK and their tax agreement, or whichever two countries are involved in that situation. Now, briefly, just going into corporate structuring, because this is a whole separate presentation on its own, but there are always a few things that are worthwhile considering when it comes to corporate structuring, or even if it's not necessarily a massive corporation, but it's just a sole business, as a previous one, just a family-owned business, there are certain things to consider. Now, a lot of countries have what's called controlled foreign company, or CFC for short, rules. As I mentioned, the South African ones have a clause in them that essentially, if you're operating a foreign company that has a specific tax rate that's within a certain percentage of the South African corporate tax rate, it wouldn't be seen as a controlled foreign company. Other exemptions apply that if that foreign company has a branch or office or makes significant decisions from that other country, then it wouldn't be seen as being controlled in South Africa. Essentially, this stops someone from setting up a company in a very low tax jurisdiction, having all the profits accumulating there, and then paying out dividends in the South Africa like we did in the other case. But in that case, there was an exemption that applied. That's why you could still do it. But for example, if you have a country that has zero tax percentage, essentially they would have been able to take the full 130,000 profits out, and they wouldn't pay any corporate tax in the foreign country, and then they'll bring it all into South Africa. In this case, it doesn't apply. In that case, because it was a foreign company. But if you fall foul of foreign company rules, what generally happens is all that income from that company is taxed in your personal capacity as the shareholder. Now, it means that you as an individual are liable at your individual tax rates. So if we reverse it to being the UK, you'd be liable at 20, 40, or 45% on that income from the company, because it would basically be seen as sole trader income because you're falling foul of the controlled foreign company regulations. So bear that in mind. If you're also operating with multiple companies in multiple countries, it's always important to look at transfer pricing, which is essentially making sure that the price charge is fair and reasonable considering the market as a whole. So that's always important to have your transfer policies in place, transfer pricing policies, so that can be always considered, and then therefore you don't have any issues with that. Economics, substance, and local presence. As I mentioned with the CFC rules, you need to prove that you have economic substance or local presence in that foreign country to be considered a UK company or a Spanish company or South African company or any other country. There normally always has to be some sort of local presence. It can't just be a PO box for a majority of the countries. And then tax policy changes. The tax system in the world is always changing, as we all know. Countries are always bringing in new exemptions or taking away exemptions depending on who's backing them or who's asked for what as their campaign providers. So that's always something to bear in mind. Double tax agreements can change. So while you might have set up a structure that works for now under a certain loophole or a certain tax break that's been given, that might not always be available. So therefore, it's always important to consider that and be able to pivot to something new. In all of that, I've basically just discussed the UK side of things, but there's a lot more to discuss when you're an expat living in a foreign country or have moved to the UK from a foreign country. And all of these things are different considerations to have in mind. Now, how can we help when it comes to this? You can come to us, you can book a free 15-minute call with us, where we will essentially look at your case, assess it on a personal basis, and then provide specific advice on your situation. Our fees generally are an upfront assessment fee, which means it's not an ongoing fee that is going to continue to rise if it takes us longer to assess your situation. Unless there are extreme circumstances, your fee is set, therefore you know what you're getting, and we would then provide you with an assessment or a report based on that, or a self-assessment if you need that done, or a tax return or whatever it might be. So you can also sign up for our social media and mailers, and then you can keep up to date. We often provide tax tips, webinars, and a lot of other formats of content that can be used to help you with your tax situation. Now, with that said, as I mentioned, the 15-minute calls, you're always welcome to book a free 15-minute call with us where we will address your situation, either via myself or one of our other consultants within the team, and then we'll be able to give you guidance from there. But I'm now going to open up the floor to questions, and we can take it further from there. Thank you, everyone. So someone has asked, once advice has been given, how is advice implemented? So essentially, if you come to us and you're asking for, let's say, a structuring assessment, we will give advice on how that structure can be, what would be the best. So saying that, considering your circumstances, saying you can either go this approach, A or B, and state what the tax consequences are in each situation, and then we'll provide advice on how that can be implemented. Essentially, we do provide accounting and bookkeeping services for South Africa and the UK. So if your structure involves one of those countries, we can then help you with doing that, setting up the company, doing payroll, doing your accounts, and managing it from there. If you need further advice, you can then book once-off consultations from there or do further assessments as required. And then we'll make sure that either if it's in a foreign country, get you in touch with a partner who can then help you in one of those foreign countries as well. Another question, can I be dual tax resident? What would have to go to the double tax agreement to see how I'm taxed, and how does this work? So yes, you can be dual tax resident. You don't have to cease tax residency in certain countries. Some countries like South Africa charge an exit tax when you cease tax residency. The UK doesn't, but you can apply the double tax agreement then to see which country would have first taxing rights or which country would be deemed as a tax resident under. But therefore, that being said, let's say you're a tax resident in South Africa and the UK, but you're earning income in Spain, that double tax agreement and where you'd be seen as a tax resident between that is only applied to income from South Africa and the UK. So if you're earning income in Spain, you'll still be liable to tax on that both in the UK, South Africa, and Spain. So it's important to bear that in mind, and how that would play out depends on the countries and the double tax agreement. Are there any more changes planned in SA or the UK which affects expats in the UK? So from a South African perspective, there's no current legislation that's been brought in or ideas that has come in with the ceasing tax residency process, but it's based off the current rules. In the current rules, you can also backdate your ceasing tax residency to when you originally left South Africa. So that's a very useful thing to do because, like I said, like the UK, South Africa is the same. You're liable to income or tax on your worldwide income. So therefore, if you've bought foreign properties or started earning foreign income, it's a good idea to go back and backdate your ceasing tax residency if it suits your case, because then you'd be exempt from all foreign income. And with that, South Africa might change their laws and not allow backdating anymore. So it's important to apply the current rules. And then from the UK perspective, there are no further changes at this point other than what's been mentioned with the temporary repatriation facility and the foreign income and gains regime, which apply for those specific years mentioned, 4 years for any new resident. There's no specifics on if it's the 4 years from April 25 to April 29, or if it applies any time after that. And then once again, the UK could change that and state it's only new residents in those 4 years. Is there tax on inheritance from South Africa? So I'm guessing this is from someone situated in the UK. Inheritance, it won't be taxed if you're receiving inheritance from another country. So you're receiving South African inheritance from South Africa, and you're situated in the UK. That's a taxed in the estate in South Africa, so you won't get taxed on it in the UK further. As additionally, and then the same thing with the UK. If you receive inheritance from anywhere else, South Africa and the UK apply the same way. You won't be taxed on that inheritance you receive. It's taxed in the estate, and you receive the net after tax. Is your first tax year in the UK either split year or remittance based, or can it be both? It can be both, so therefore you can apply split year treatment. Essentially, split year treatment would apply in the same way as remittance basis in this way, that you haven't brought the money into the UK, but for example, if you worked for 6 months in a foreign country and you've now moved to the UK, but you need all those funds to come over to you to start your life in the UK, because you brought it into the UK, that would then be seen as income. It wouldn't be seen as remitted or unremitted income, and therefore you would apply split year treatment, so that's not taxed in the UK. If you cease tax residency in SA, is it quite simply reinstituting your tax number should you decide to move back to SA? Yes, that's a very good question. So South Africa will happily welcome you back. The government will definitely not complain. You basically, if you've ceased tax residency, your profile and e-filing would be put into a non-tax resident state. So if you haven't deregistered your tax number, you simply would need to go back into e-filing and rechange your tax status to being South African tax resident. With that, there's different ways that can apply. If it's your intention to move back to South Africa and have it as your permanent home, you can apply that from day one. If you are only coming back to South Africa for periods each year, then you can look at physical presence, which takes up to 6 years to become tax resident. So you can kind of use the system there, but to not be seen as tax resident in South Africa. And then further, if you have deregistered your tax number, you would have to go and re-register your tax number. It's a bit of a longer process, but it's simply, that's how you would do it. if I'm a UK tax resident for 2 years before the FIG tax year, do my earlier 2 years count in FIG? So how it applies is if you're a tax resident for 2 years before April 2025, those years you'll be able to claim TRF and remittance non-domicile basis, and then your 2 years after that you'll be able to claim FIG. So FIG doesn't apply before 6 April 2025. It only applies to income earned after 6 April 2025, TRF before 6 April 2025. That's the simplest way to explain it. Further question, how will your SA fixed property assets be affected by UK tax law changes, i.e. income and capital gains? So with the changes in the laws, your South African properties would be taxable in the UK based on from 6 April going forward. All of that income would be taxable in the UK. So you'd pay tax on it in South Africa due to it being a South African source asset. Any profits would also be taxable in the UK. South Africa would have first taxing rights, so you'd take off whatever tax has been paid in South Africa, and then you'll be able to use that as a deduction against the tax payable in the UK. But any income will be taxable, and as well as capital gains in the future will be taxable. If you have ceased tax residency in South Africa, just bear in mind that you will be liable to withholding tax on the sale of that property in South Africa. I'm working full-time in the UK, but still on a work visa, not ILR yet, and I'm a South African citizen. I'm a beneficiary of a family discretionary trust in South Africa and receive annual capital after tax distributions from the trust into my SA bank account. I then transfer those funds into the UK bank account using my SA discretionary allowance. Are these funds taxable in the UK when I transfer them over? Do I need to just clear these funds? And is it only interest earned on these funds in the UK that is taxable? So trusts make it quite complicated because the way it's taxed in South Africa is different to the way the UK see it. Essentially, the UK will see it not as capital that's distributed. So in South Africa, it's capital, you're receiving the net, it's being taxed in their trust. But the UK sees it as being income, and therefore you're liable to tax on that income. So once again, if it's not remitted, it's not taxable. If it is remitted, it would be taxable. If you haven't ceased South African tax resident, as you said, you can use your discretionary allowance of the 1 million rand per year to bring it over. If you have to get approval for those funds from the first cent. So I'm just reading it again if there's anything more. So yes, you would essentially need to declare these funds and claim that it's foreign trust income. But it is quite a complicated area, so I would suggest a 15-minute consult just so we can break it down further and see what exemptions can be applied or where these funds might be exempt or how exactly they would be taxed in the UK and what credits can be used. Any further questions? Right. Joining us today with this webinar. If you have any further questions, please feel free to pop me an email or book a consult with myself or the consulting team, and we'll then be able to elaborate on your specific question further. But thank you all for joining us. Have a great rest of your day and week. Thanks, everyone. Cheers.